This is Intelligent Investing presented by Fidelity Investments. Late last week, President Trump announced that the U.S. would impose tariffs on imports of steel and aluminum. U.S. stocks broadly sold off after the announcement, while domestic steel companies got a small boost. This decision could cause retaliation from other countries and possibly a trade war. A recent note from Fidelity Viewpoints identifies the likely losers of protectionist trade policies. First, countries most dependent on exports will be hurt by U.S. tariffs. Small economies more open to trade have a lot at stake, such as the Netherlands, where exports and imports make up 140% of the country's GDP, and emerging markets that have benefited from developed market demand, such as Mexico and China, are likely to be targeted by U.S. policymakers. Other losers are companies that get a lot of their revenue from outside the U.S. For example, in the U.S., half of the revenue from the tech sector comes from abroad, while U.S. revenues in utilities and financials are almost entirely domestic, which means these companies will be less impacted. Truly global companies that sell internationally and are dependent on access to foreign markets will also suffer. And the final loser is anyone that benefits from lower prices on imported goods, both U.S. consumers and businesses. While it's unclear how this will all play out, Fidelity points out that the broader issue is the possibility of escalating anti-trade policies, which could slow or even reverse global growth and spur inflation.